So, and I will be speaking in general across all EMs, not focusing on any specific country or region. And before I jump into it, I should give you the usual proviso that the views expressed here are my own and do not represent official IMF views. So first, and going back to Montek, what you said at the beginning, that all countries are recovering. It is, however, important to keep in mind that the pandemic is still with us, and emerging markets have been really severely affected by it and still continue to grapple. Here, I'm showing two charts that are telling. The first one on the left shows that the number of deaths from the pandemic in the first half of this year has, the countries that have seen death from the pandemic have increased this year compared to the last half of 2020. And this really underscores that the pandemic is still with us. And new variants continue to circulate in emerging markets in the context of low vaccination rates, as we can see on the right-hand chart. And, it's important also to understand how harsh the shock on emerging market economies has been. Of course, the pandemic has had a significant toll on both advanced economies and emerging markets, but advanced economies are recovering more rapidly. The recovery is not only uneven across country groups, but also across sectors within emerging markets, as you can see on the left-hand chart. The recovery is expected to continue through next year, with growth accelerating in most countries. As a group, however, emerging markets are projected to fall behind their 2019 output levels, lagging behind the advanced economies, as you can see on the right-hand chart. I should note that these estimates and all the estimates I will use in this presentation refer to the calculations that we have done at the IMF for the July vintage of our World Economic Outlook. Next week, we are releasing our most recent projections, but the picture overall remains the same, especially as regards the divergence of speed of recovery across emerging markets and advanced economies. So moving on, it's important to remember that the pandemic initially had caused financial stress in the early part of 2020. We have seen large capital outflows that took place, and in fact, the capital outflows in March 2020 were the largest since the global financial crisis. So outflows from Asia were particularly strong, and also outflows in equity markets, from equity markets. Other signs of stress that we show, I don't have.
Yes. Can I just, would it be possible to maximize the screen? It's too tiny for most people on YouTube to see it.
This is the maximum that I have.
Okay, sorry then. I thought you could do it. And for those who are not speaking, do you mind muting your mic, please? Thank you. Go ahead. So, yes, much better. Thank you.
Okay. So we have seen, financial stress in early 2020, but thanks to quick policy reaction, in particular substantial and coordinated actions by central banks to provide liquidity to banks in many economies, including through repo operations and provision of dollars via central bank swap lines, this has helped stem the outflows and the financial crisis was averted. Now, with the strong policy response, as that I've just mentioned, we have seen outflows stopping, as you can see on this chart here. And this, together with an improvement in other capital account balances, implied that the loss of reserves from this episode was fairly contained. And in fact, by the end of the year, many emerging markets saw reserves actually increasing, and we expect by the end of this year, 2021, an even more further increase in reserves. The right-hand chart shows the share of emerging markets that have reserves at a certain percentage of the adequate level as we assess at the IMF. Parametric stands for Assessment of Reserves Adequacy, and this is a benchmark that we calculate to assess reserves coverage. And you can see on this chart that nearly 60% of countries entered the COVID crisis with reserves above the level of adequacy, but by the end of this year, in 2021, we will see an even slightly larger number of countries to continue to have strong reserve buffers. And I should note here that the new SDR allocation by the IMF is helping. Another important features of emerging markets is that current account balances coming into the COVID crisis were stronger than at the eve of the global financial crisis. And these current account balances actually slightly improved during the pandemic. This is because of the large import compression due to weak domestic demand, which has implied an increase in private saving investment balances that helped buttress, or make up for the large public sector dissaving. Actually slightly improved. Now, the final piece of the picture that I want to paint for the macro situation in emerging markets refers to the financial sector. Here, what is important to note is that banks entered the COVID pandemic with larger capital and liquidity buffers than they had at the eve of the global financial crisis. This has certainly helped them through the pandemic, together with the extraordinary policy support, including the coordinated action across a number of large central banks that I spoke of earlier. So the picture that I planned so far, that I painted so far, is that of emerging markets that have been severely impacted by the pandemic, but have averted a financial crisis, both because they had, significant buffers going into the crisis, and because of really strong and substantial and coordinated policy action. Now, turning to the second part of my presentation, I want to cover the vulnerabilities that we can still see in emerging markets, and these are where we need to pause a little bit. Given the space, I will focus on three main important vulnerabilities here. The first relates to real economic activity, which has not yet recovered to pre-pandemic levels. The second refers to the rise in debt, which implies that the fiscal firepower is diminishing. And the third refers to private sector fragilities. So first, on the economy. High-frequency indicators suggest that the economic recovery in emerging markets has not yet reached solid ground. For example, we have yet to see a sustained improvement in PMIs, which have dipped again slightly below the break-even point in August. So indeed, when we look forward to near-term growth prospects, we see that they are highly uncertain. Growth could accelerate, for example, if we have better cooperation globally on vaccines to help prevent renewed waves of infection and allow for faster normalization of economic activity. But downside risks dominate, and most prominent among them, of course, are those related to greater than expected damage from COVID-19 and, scarring. In addition, as the pandemic lingers for longer, with repeated lockdowns possibly, even if they are more localized, the recovery could be held back for longer. One notable aspect of this conjuncture, which I spoke to earlier, is this, two-speed track, the divergence we are seeing between emerging markets and advanced economies, and with the pace of the recovery slowing more in emerging markets. In such conditions, two issues arise. First, investors' confidence remains fragile and subject to reversals should a large shock occur. And second, the divergent economic recoveries mean that monetary policies may need to diverge across emerging markets and advanced economies. And so here, for example, and most relevant for our discussion today, is the risk from persistent and more persistent than expected inflation in the US, which could trigger faster than expected monetary policy may need to diverge across emerging market normalization in the US. And this would result in tighter global financial conditions. If this happens and the shock is significant, it could create large capital outflows that could put pressure on some vulnerable emerging markets. And for those emerging markets where the recovery is stalling or is, weak, monetary policy may be constrained in its response to this global financial shock. The dilemma will be, should the emerging market tighten to stem capital outflows, or should they stay the accommodative course to support the domestic economy? And at the risk of painting an even more complicated picture facing emerging market policymakers, let me say a few words about inflation in these countries. We have seen a pickup in inflation in almost all emerging markets, just like we have seen it globally in advanced economies, as you can see on the left chart. This is driven by the recovery in commodity prices, by supply disruptions across global value chains, by increased shipping costs, and some recovery, although not full, in domestic demand. At the same time, the recovery remains weak, as estimated output gaps remain negative, as you can see on this chart. So rising inflation and still negative output gaps could create a difficult trade-off for monetary policy already for domestic conditions, let alone, the possible global shock. As estimated output gaps remain. Another vulnerability we see in EMs today is linked to the fiscal policy that was necessary and that was required during the pandemic. It was necessary because the negative growth impact of the pandemic would have been even more pronounced in the absence of substantial policy support, and it was necessary to address the health crisis. So what was remarkable indeed in this crisis, and here I show the two charts that discuss fiscal and monetary policy stances, we have seen that there was a significant share of countries that have mustered policy support using both these levers, the health crisis. So the flip side of this unprecedented fiscal support was a rapid accumulation of public debt across most countries, and particularly so in countries where public debt was high to start with, as you can see here in this part of the left-hand chart. And many economies still need support until the recovery gets fully entrenched, which poses challenges given diminished policy space. This year, the share of emerging markets with loose fiscal policy stances, as assessed by the IMF, has decreased noticeably. You can see it here on the right-hand chart, but it remains above 50%. From what we know from the fiscal policy plans in emerging markets, we see that this move towards consolidation is expected to be even more pronounced next year as the recovery proceeds, and the need to rebuild fiscal buffers becomes even more prominent. So we see today that public debt levels have reached unprecedented highs in many emerging markets. They have jumped more than 20 percentage points between the end of 2012, right after the global financial crisis, and the end of last year. Let me go now to the last vulnerability I want to talk to you, which is in the private sector, and more specifically in private sector balance sheets. So as I mentioned earlier, the banking system seems robust. They had significant buffers going into the crisis, and the policy support helped them a lot. However, as this support will start to be withdrawn, banking systems could be tested. When the support measures are rolled back, we would expect a rise in the share of creditors that will not be able to meet their loan obligations. And this is probably particularly so in the sectors of the economy where the recovery is sluggish. So bankruptcies will likely rise, and associated losses could strain the banking system's remaining buffers. Another aspect of private sector balance sheets that need to be watched are the currency exposures. Countries with large unhedged foreign exchange liabilities that are held by the private sector may be vulnerable to tightening the global financial conditions. Private non-financial foreign exchange debt as a share of GDP shows a large cross-country variation, as you can see in this chart, but a few countries have very high exposures in the corporate sector. So in these countries where these corporates have offsetting foreign exchange assets or hedges, the issue, would not be as concerning because they would be relatively protected. But if there aren't such mitigating conditions, then the vulnerabilities would be even more acute. So let me conclude now by just stating a couple of key takeaways. I think what I've tried to show is that the pandemic is still flaring up and has had a significant toll on emerging market economies. This caused financial stress early on in 2020, but policy responses, both domestically and importantly, the coordinated policy response across major central banks has helped contain the fallout. External positions were relatively strong coming into the crisis compared to, for example, at the time of the global financial crisis. And in fact, these external positions have slightly improved during the pandemic. And banks, which were resilient at the onset of the pandemic, have held up thanks to the extraordinary policy support. Still, it is important to remain vigilant, notwithstanding the strong footing of the external and financial sectors. EMs are really vulnerable because the economic recovery is still fragile and policy space is constrained amidst high public sector debt and private balance sheets that can mask underlying vulnerabilities. And these vulnerabilities will not become clear entirely until all the moratoria and policy support are fully phased out. I will stop here. Thank you.
Thank you. Thanks very much, Nada, and thank you for pretty closely adhering to your limit, actually, for which many thanks. Our next speaker, I have a great pleasure in inviting Mr. K. Subramanian to now address us all.
Thank you. All yours. I'm going to make observations in three broad buckets. Firstly, I'll continue from what Nada spoke about on the economic recovery in the Indian situation. I'll then interpret what we see in terms of the macro indicators using the policy response that India has had, in the pandemic, distinguishing it both vis-a-vis the policy response during the global financial crisis that India did and the global policy response itself. That will be the second part of my observations. I'll then end with projections for how I see the economy, and if I have time, I'll also talk about how I see the banking sector and possible impact of on the taper tantrum, if anything, or the tapering. So let me start by Nada talked about how portfolio outflows have happened in emerging economies, significant outflows. Here, India has been a positive outlier. India has had foreign FPI inflows of $36 billion over the last year, and I'll contrast that to the $10 billion outflow that happened in during the global financial crisis, the year of that. And on the FDI itself, India has had an inflow of $80 billion in the last year, compared to $8 billion during the global financial crisis, so 10 times more, and almost 3.5 to 4 times more inflows during a period where other emerging economies have had outflows. So that's the first indicator that I want to look at. The other three, I think, which is very important: current account deficit, inflation, and fiscal deficit. But before I talk about that, let me just highlight the V-shaped economic recovery that has happened. Those that might have been following the Indian economy and some of our media interactions would have noticed that last year, after the first quarter, when the decline of 24.4% had happened, I had mentioned that this number was only because of the intense lockdown that happened. There's nothing wrong with the fundamentals of the economy, something that I've been saying consistently all during, during these 3 years that I've been in office. And also mentioned that there is a V-shaped recovery that is on by looking at the high frequency indicators. That is indeed what has transpired. If you plot the 7.5% decline for Q2, 0.4% positive growth for Q3, and 1.6% growth for Q4 of last year, and then a 20.1% growth in Q1 of this year, that indeed looks like a V and no other letter. So I think that's testimony to the resilience of the Indian economy and its fundamentals. If I have time, I will comment on the slowdown before the pandemic, the reasons for that. But I think during the pandemic, India has had a V-shaped recovery. If you look at the 3 key macro indicators, let's first take inflation. Inflation on average has been 6.1% last year, after recording a little higher than 6% during the 2 months of the second wave of the pandemic. It has started declining, in the last 3 months. It has consistently declined. Last month, the print was 5.3%, which is comfortably within the range, that policy range for of the Reserve Bank of India. Let's contrast this with what happened during the global financial crisis, where inflation was in double digits for several months, and at its peak had reached, had gone more than 12%. And it is crucial to understand that double-digit inflation happened despite no lockdowns, despite no night curfews, which create supply-side frictions and really disrupt the supply chains. So, if we think about a counterfactual, and which is something I'll talk about why this has happened in terms of the policy response. If our policy response had not been what it was, you can then sort of counterfactually think that with the additional supply side frictions caused by the lockdown and the and the supply and night curfew, etc., we might have been in a situation of 15%, 16% plus kind of inflation. Compared to that, I think the 6%, marginally greater than 6%, I think has been has been really very, very good. Second, if you look at the current account deficit, last year India ended with a current account surplus close to 1% of GDP. This first quarter as well, again, there's been a very large surplus. In contrast, we had become part of the fragile five after the global financial crisis, when the current account deficit had touched close to 5%. And when you look at the fiscal situation itself, India ended, if you take the central government's finances, we have ended the year at 9.2%. And if you look at the IMF fiscal monitor, our peer economies, other emerging markets, their fiscal deficit, the central government has been 10.5%. So we've actually done better in terms of our fiscal response. And let me just contrast this aspect as well vis-a-vis the global financial crisis. India's fiscal deficit then, the year after the global financial crisis, was 6.1%, when the peer economies were way lower at 2.5%. So this basically contrasts the Indian economic performance, but I'm just giving you the sort of the major indicators. Now, why has this happened? This has happened because India's policy response has been different, not only compared to the global financial crisis, but also compared to other countries' policy responses during this COVID crisis itself. If you look at both the global financial crisis, the policy response in India, and the COVID response now in other emerging other countries, especially advanced economies, it has been basically just a Keynesian prescription of demand side measures. In contrast, India has actually focused on supply side measures, especially on the Hicks-Samuelson model of accelerator multiplier from investment, focusing on capital expenditures. In a democracy like ours, demand side measures are actually far easier to do, because they're actually they sort of can cater to the populist demands. In contrast, supply side measures are far harder to do, and based on my own experience, having lived in the United States for 10 years and contrasted India to advanced economies, emerging economies like ours really need supply side measures, because those are the ones that really bite, constraints that bite, and India has actually done that. Now when you contrast and you take that actually if you do only demand side measures, which is what advanced economies have done, it is not a surprise at all that globally commodity prices are, there is inflation. You're actually seeing inflation, in terms of on power as well. You're seeing exports being affected by shipments, all through supply side frictions biting, because the global response has been only focused on demand side, much like the same prescription that was followed, following the global financial crisis in the Indian context. In contrast, we've done supply side measures, which is far more difficult, but really important. Now, when you look at the impact on growth that that this will have, I'll talk about that later. A couple of other very important things amidst a pandemic, a once in a century pandemic, where every other country was just trying to tide over the pandemic. India has really utilized this opportunity to bring in path-breaking reforms, and I'll compare them to the 1991 reforms. The 1991 reforms were product market reforms, very seminal, really important, and Montek himself was at the center stage of that. But if we look at reforms that are being done now, these are factor market reforms. And factor market reforms in a democracy like ours are far more difficult to do, because the rhetoric and the political economy is such that factor market reforms can always be posed as affecting common man, and I think that is something that is very, very, very important. So whether it's the labor market reforms, the farm bills, farm reforms, the enterprise policy focused on private sector, where privatization is actually the result of that, the opening up of defense sector, the recent measures, telecom sector reforms, and the amendment of the retrospective taxation that was brought in 2013. When you put all of them together, and actually for want of time not listing many others, you will see that the impact of these measures will be both on bringing in productivity gains. So this will bring sort of incremental capital output ratio will get impacted, and investment as well. And one key change in India's economic thinking that has happened, amidst this policy change, is the focus on wealth creation. All of the times where we actually thought about, wealth or wealth creation as a bane, that was actually a residual of the socialist era. Now, and India is returning back to its DNA, thinking about wealth and wealth creation as boon and not necessarily as a bane, but focusing on ethical wealth creation itself. So I think the policy response is clearly responsible for the macro measures, the difference vis-a-vis both the global financial crisis and the current situation in the advanced economies. Now let me actually talk about what does this all mean for for economic prospects going forward. First, because of the increase in the the capital expenditure, this year's budget has projected a 35% rise in the capital expenditure compared to last year. So both in terms of the rupee value that is going to go into capex, as well as percentage of GDP, India will be investing in capex far more than ever in its independent, since independence. And that is really important, because as we showed in the economic survey, public capex crowds in private investment, and that is something that is important for us to be, to focus on investment-driven growth, the virtuous cycle of investment-driven growth. Second important part is actually, so through the increase in the gross fixed capital formation in the economy, which I anticipate should start hitting close to 40%. Let me just mention that in the second and third quarters, the gross fixed capital formation to GDP was 33, in the third and fourth quarters, of the last year, it was 33% and 34%, much higher than the average of about 28% before the pandemic. And I expect that to accelerate as many entities like Vedanta, Birla Group, etc., are talking about, doing private investment. So this will increase, combined with the government's push on capex itself. And privatization, asset monetization, the labor reforms, the farm reforms, all these will start having impact on productivity reflected in the ICRIER. And so together we expect growth to actually accelerate, in the coming years. That growth and the growth interest rate differential, which in this year's economic survey we had shown that debt sustainability eventually is determined by the R minus G differential. R is the nominal rate of interest on borrowings, and G is the growth, rate of nominal growth. Olivier Blanchard in his AEA presidential address, talked about this, and we've done the same exercise for India. That differential going forward for India should be at least 4%. With nominal growth 10%, that is 6% at least real terms, 4% deflator, 10% nominal growth, and borrowing costs about 6%. So that will really help to bring down the fiscal, the debt to GDP. And as I just mentioned earlier, even though we entered the pandemic in a worse fiscal situation, we've been very, very prudent, and compared to our peers, we've actually we've managed much better on the fiscal side. Let me end my comments with just a couple of points on the banking sector side. There was a big worry for me, entering into the pandemic. It was the banking sector, because unlike other economies, we were entering the COVID crisis with an injured financial sector. And so I must say I've been pleasantly surprised by how the banking sector has emerged. 4 key facts. If you look, it's become profitable, NPAs have gone down, and that's in terms of the existing situation. When you look at the NPAs that are inevitably going to come on SMEs and on retail, the 2 key lines of defense, which is provision coverage at almost 90%, and equity, which is your CRIER at 14.4%. The first line of defense and the second line of defense are very important to withstand the bad loans that may come. So banking sector looks to be in good health. And that is important because the slowdown even before the pandemic happened primarily because of the financial sector. So, with the reforms that have been done, many of those, and in the interest of time, I'll not go into the details, but the creation of the bad bank, the privatization of 2 public sector banks, which, measures for which are likely to be announced soon, the DFI, Development Financial Institution, for the capex driven growth, and the 71% insurance limit, FDI limit for insurance. These reforms for the financial sector combined with this banking sector performance means that credit generation, I think, should be higher and should further grow. Last, let me end with that, the prospects, how India might fare during the tapering inevitably that will happen. Given the fundamentals of the economy, and I talked about the CAD, the current account deficit, I talked about inflation, I also talked about our fiscal situation. Each one of them actually looks much better now compared to what it was during the global financial crisis. So I anticipate that while there may be some short-term impact possibly, and there is one key difference now, the Fed is actually setting expectations much better. Therefore, even the short-term impact, I think, may be little moderated. There may be some short-term impact, but overall, I don't think the tapering process will affect the Indian economy that much, because the fundamentals we've actually, through our policies, have ensured that it is really strong. Thank you very much.
Thank you very much, Mr. Subramanian. That's a spirited presentation of the strengths of the Indian economy. Now we will move to the third panelist, my old friend Stephany. So Stephany, it's all yours. Thank you very much, Mr. Subramanian. That's spirited.
Many thanks for the kind introduction and for the kind invitation by ICRIER. I'm very delighted to join this excellent panel, which is so ably chaired by Montek, as he said, an old friend that I'm delighted to be. So I want to first outline very briefly, because the previous speakers have been so clear, what the dilemmas are, and I think particularly for the need for sustainable and fair recovery worldwide. So we have a situation where, as a result of the pandemic, we have a decline of income in advanced economies by about 2.8% based on the year, based on IMF figures, related to pre-pandemic trends. But we have, if we take all emerging and developing countries, excluding China, we have a decline in per capita in yearly rate of 6%.
I've sent you a question on WhatsApp. Can you go ahead?
Okay. So we have, as the IMF has been emphasizing a lot, we have a very divergent recovery. And one of the important reasons for this is that there has been a very differential fiscal and monetary response between these categories of countries. And again, using IMF data, the fiscal response in advanced economies was around 14% as a response to COVID, whereas the emerging economies on average had a fiscal response of 4%, and the low-income countries about less than 2%. So we have very asymmetric policy responses, and of course that was not because the emerging economy and low-income countries, policymakers didn't want to do it, but because they didn't have the policy space, the capacity to borrow, and so on. So I think that, and as a result of that, poverty has increased a lot. The World Bank gives us figures of over 100 million of extremely poor people, people going into extreme poverty. And estimates for Latin America are that it has regressed 2 decades in terms of the quite good social progress it had made in the previous decade. So we are actually in a situation which is, I think, quite serious, although, of course, welcoming the recovery. And also facing the vulnerabilities that have been pointed out, exist and that may arise as a result of an increase in interest rates. So what are the measures that the international community can take to help sustain recovery, and also, I think, to make it more green and more equitable? The one measure which I think is very encouraging is that the international community has issued 650 billion SDRs. I mean, this is something that was very much pressured by developing and emerging economies, and also, I think, to the Biden administration, it has actually happened, which I think is great news. Of this, 250 billion go to emerging economies and the rest goes to the rich countries, which actually don't use SDR, so they don't really need them. And I see that India got 18 billion SDRs, which is important. But the problem is that, for example, the low-income countries, all of them have got only $21 billion. So there is a need and a growing discussion of the possibility of reallocation. And again, the good news is that the G7, in general terms, not formally, have committed to transfer 100 billion of their own SDRs, either from the new issue or from their existing SDR reserves, to so-called vulnerable economies, 100 billion. And there are commitments. France has said that it would reallocate 20% of those SDRs, and the US has talked maybe about reallocating 21 billion. But this is not firmed up, nor even less has it happened, although it's very encouraging. And it's also interesting that some countries have already used, with the allocation that they received, emerging economies, have already used the reserves. For example, Colombia has allocated the equivalent of the money it received in SDRs to increase government spending in the social sector. And Senegal is talking about doing that. So we have concrete cases of how this works to expand space. So how could this reallocation happen? And I just want to briefly talk about the different options that are being discussed and that will be, I think, intensively discussed in the annual meetings. So one idea is to do this reallocation within the IMF. So, and the more classical mechanism is to do it through the PRGT, the Poverty Reduction Initiative, which is a facility existing in the IMF. The problem it has is it's only for certain very poor countries, mainly the LICs and the LMICs. And the second problem is that it has conditionality, which is really not what SDRs do, because normally SDRs are just transferred without any conditionality. But that is, I think, perhaps more likely thing to happen, at least to proportion of these resources. But there's also growing interest and discussion about using these SDRs for long-term needs. There's talk, including at the IMF, about a resilience and sustainability trust, RST, which would give money to the most affected and the most vulnerable countries. I think not just poor ones, also middle income, to prevent and respond to climate risks and to help make climate adaptation and mitigation a just transition towards net zero by 2020. So that is a second option. And a third option is to use the SDRs to channel the funds to institutions outside the IMF. And a particularly important one is to use it to give more resources to the multilateral development banks and the regional development banks. And you could do that through two mechanisms. One would be just to lend the SDRs to the MDBs, and they would on lend it to countries in need, which would be good. But there's also another, I think, more interesting option, but difficult to implement, which is to use those SDRs to strengthen the balance sheets of these development banks. And therefore, these development banks can then borrow on the capital markets, on the private capital markets, and then they can leverage the resources and lend more than the money that they would get via the SDRs. So I think this is very interesting option. So my second point in terms of what can be done by the international community is precisely related to the response by multilateral development banks. And I think that it has been encouraging that these banks, the multilateral and the regional, and including the new ones like the Asia Infrastructure Investment Bank and others, have increased significantly their lending commitments by, we estimate is by 46% last year, by 2020, which I think is quite impressive as a very good counter-cyclical response, precisely as the previous speaker was saying, to try and maintain not just economic activity today, but also maintain investment. So this is encouraging, but there is a problem that a lot of these institutions are reaching the limits of their lending capacity. For example, the African Development Bank is running out of space, and indeed even the World Bank is also. So I think there is a need to recapitalize banks, multilateral ones, which would be very important. It's interesting that after the global financial crisis, in fact in London, in the spring of 2009, under the leadership of Ben Gordon Brown, who was chairing that meeting, the capital of multilateral and regional development banks, it was agreed that they will be recapitalized. And this hasn't happened. And I think, particularly if there are problems with private flows, for example, as we've discussed before, this would be a very kind of strong reserve mechanism. And my last point in terms of policies that may need changing is the issue of debt relief. I mean, there are some countries that are very heavily indebted. And and that they were already actually in the run-up to COVID. But as a result of COVID, for example, Africa has become more indebted by about 10% of an additional GDP, and 10% additionally by 10% of GDP, from levels that were already very high. And so there is, I think, a need for debt relief for those countries that need it. I mean, obviously, the country is solvent and has access to private flows, that there is no need. But I think there are fears that a lot of them needed now and many more may need. And there is a very interesting trend, I think, in the discussions, including at the IMF and the World Bank, but also in sort of think tank circles in which I'm quite involved, of trying to think ways of linking debt relief and to sustainable and inclusive recovery. That is the idea, that you would have a sort of macro, mega debt for climate swaps at different country levels. And that therefore that would facilitate both countries maintaining fiscal spending in the social sectors, in the health sector in particular, but also invest in climate change and invest in adaptation and mitigation and resilience. And this will be, of course, particularly valuable for those countries that are in debt distress, that are estimated to already be, for example, by UNDP, by about having 72 countries already in debt distress. And there are, of course, additionally the problems of debt in emerging economies. Some of them are very highly indebted corporate sectors to the private creditors. And so some of them should be included in the debt relief initiative, because the current international initiatives that exist are been positive, but they have been very restricted to leaks and LMICs. You have countries like the severely climate vulnerable countries, some in Asia, some in the Caribbean, even though they are mixed, even though they are middle-income countries, have levels of debt that are unsustainable and are subject to very, very strong shocks from climate, from hurricanes and activity. And I think we have to kind of integrate the discussion which I think we had before in this conference, and that is separated done on the climate emergency, the urgent need of action that the planet cannot wait, with the fiscal response and the policy space that emerging economies and developing countries have. Because there is, this is a global public good, and everybody is interested in preserving the planet and avoiding this terrible climate increase of temperatures that we have been witnessing and all the desirable effects. So I leave you with those three measures that I think could be used. And maybe I should just mention that on the SDRs, I forgot to say that I thought this was a tremendous step that was taken by the international community. I think one has to consider whether more regular SDR issues should be carried out, particularly when there are big needs, and to use it as a more regular mechanism, indeed even of funding the IMF and providing more resources for the IMF to continue lending particularly when there are special situations like the one we've had from COVID and we had particularly when there are. Thank you very much.
Thanks very much, Stephany. And I should apologize. I kind of introduced you as an old friend, but I should also have said that you are the financial markets director of Columbia University. But it's just that whenever I think of you more as a permanent spokesman of the interests of developing countries. So I forgot to mention your formal title, but although late, I'm happy to mention it now. But thank you very much for your remarks. Now, I know that an old friend, N.K. Singh, who I think is part of the audience, sent me, before I make any comments, I'd like to bring N.K. into it. Deepak, can NK intervene at this point? I mean, do you know how we should do that? Happy to mention it now, but thank you very much.
Depends on which platform is he connected in. If he's in WebEx, he can. If he's in Zoom or YouTube, we can't hear him. But I would suggest anyway he should try to speak. If we can hear him, then that's good.
Okay, well, NK, if you're listening to this, see if you can speak, and if you can't, just send me a WhatsApp of your question, and then I'll put it across after I've just addressed a question to Nada. So we'll give NK a chance for a minute or so to see if he can log on. Well, NK, if you're listening to this, see if you can speak. And
also ask our teams to send him a link for joining as a panelist. Let me ask them to do that.
Okay, Deepak, can you send him a WebEx link so that he can join?
Yes, we are doing that. Yeah,
we're doing that right now.
Okay, so shall I while you do that, maybe I can just go to Nada. Nada, you're there, I can see you. You know, the question I had for you was, I think Stephany's raised she's referred to the big SDR allocation and how with a little bit of financial engineering, it might be used. What would actually be a pretty surplus allocation for the developed countries might actually be used to help developing countries if the advanced countries wanted to do that. To your knowledge, has the IMF explored whether this is technically feasible? You know what most people think? I mean, when you use SDRs, you have to pay the IMF for using the SDRs. So whichever countries SDRs are being used, they would pay that very low short-term interest rate. But on the other hand, with a bit of financial engineering, this can be made a long-term loan. You just keep paying the very short-term interest rate if they're willing to do that. So is it technically possible? I mean, that would be quite an interesting type of coordination, which is really what the G20 is about. I mean, if it's just a question of going to the IMF and asking for assistance, the IMF is there and countries go to it and so on. But this is where you need a bit of engineering beyond the IMF itself, with the major countries willing. So my question to you is that, has the IMF, to your knowledge, been exploring this possibility? And if you're not in a position to say what they're doing, can you personally give some view on whether with some financial engineering, if the board were to agree, obviously, if the board were to agree, that it would be possible to recycle a few $100 billion of these SDRs into long-term loans, with the developed countries only paying the short-term interest rates. With some financial engineering, if the board would... So would you like to address that question?
Yes. Thank you, Montek, for the question. You know, I will say something officially, and then I'll give you, some personal remarks as you asked. Officially, what I can say is that Stephany has really presented the right situation, that the fund is looking at alternative options to channel the SDRs from countries that don't need it. And the bulk of the allocation, the 650 billion, is in fact in the hands of countries that don't really need it. So, the fund is looking at alternative ways, and there is a strong commitment by the international community, by the G20 and the whole IMF membership to make that happen. We have a whole department, the finance department, as you know very well, Montek, that is working very hard at putting together some proposals for our board. So I think we can expect some news on that front, hopefully relatively soon. Now, so this is the official remark. So personally, I mean, I think, of course, anything is possible, right? Because the IMF membership encompasses all the countries, and the SDRs that have been issued are ownership of all these countries, and the countries, they all sit at the board and they can discuss and agree on what to do with them. So if there is a need and a will to kind of channel these SDRs to the low-income countries, or the mix, as Stephany was saying, that need them for very long-term needs at very minimal interest rates, that can be done. So, but the modalities can be complicated because these are technical issues. So it may need time to put together, but the proposal has to be very concrete and has to have the buy-in of everybody involved to get done. But anything can be done for sure. I'll stop there.
Yeah, thanks very much, Nada. That's very, very helpful. And quite frankly, I mean, if you're to judge the G20 by whether it kind of steps in, bringing a higher level of coordination to action, rather than simply cheering the fund on doing its regular work, which is also important. This is really quite a major initiative. You say that there's a lot of support for this, and I guess we just have to wait and see how that gets translated. Maybe it'll get reflected in the G20 summit meeting, which is happening in October. And after all, given the huge need for assistance to help developing countries, not just low income, but even middle income countries, undertake the energy transition, which is necessary if you want to combat climate change, I mean, this would really be a very, very major contribution. So I think we can wish them all well and hope for the best, and look to see what comes out of it. Is NK on board yet? Which is necessary if you want to combat change. I mean, this would really be a very, very
no, sir.
The link I've sent him as a panelist.
All right, then actually, please somebody talk to him and ask him to send me by WhatsApp his question, and I'll pose that. And let me now turn to Mr. Subramanian, who gave a very strong and I think very credible explanation that India is in a much stronger position than we were certainly in 2008, the global financial crisis, and also at the time of the temper tantrum. Of course, some of the high investment rates that you mentioned are on a very low GDP. So I think we can't conclude that investment is on the way up, but certainly you've got 650 billion or something in foreign reserves. So I think, and I believe just yesterday, Moody's or someone has improved our rating. So that's certainly a positive factor. The question I wanted to ask you was that as we move ahead, I mean, I completely agree with what you said, that at this stage, as we wait for all these factor reforms to create a greater willingness on the part of the private sector to invest, which is going to be connected with how far its own balance sheet can be strengthened. And there are many things that are happening which are good, but they all take time. So in the meantime, I mean, I agree with you that banking reforms, you mentioned some important ones. I won't go into the details. Let's just hope that some of the implementation problems there are resolved. But one issue which I think is important is the mix of fiscal and monetary policy. My impression, and I don't know if the IMF has been advising on this, and that's maybe Nada can also pitch in, because globally, I mean, everybody is aware that it's a huge crisis, and everybody is aware that we must pull out all the stops, and everybody has done whatever they thought could be done. But I would say in the Indian case, we've done a lot more on the monetary side, and we've done less on the fiscal side. We've done some, but less. Now the issue arises that globally, there's a complete rewriting of fiscal theory going on. I mean, normally, the IMF normally says those who have fiscal space are encouraged to have a wider fiscal deficit. But this was in a world in which I think two of the IMF's own chief economists had said that, developing countries should have debt to GDP ratios of 40%, and developed countries should have 60%. So developed countries are over 100%. So quite frankly, if we were to sit down and ourselves address the question, do we have fiscal space for the next couple of years? I mean, I'm sure you're looking at this and people are wondering, what are you going to decide? And you don't have to tell us specifically, you can't. But as a general question, isn't it fair to say that we need to rethink what's a sensible fiscal position, always grounded on the assumption that we are not saying the fiscal deficit and debt doesn't matter. It's just that it's not going to happen in 1 year or 2 years. And the honest truth is that nothing would make a bigger difference to India's parameters than the conviction that we're moving to 7% growth. I think you've talked about 7% growth. So in my view, anything which gets you closer to 7% is worth doing for the next 2 years, and never mind the fiscal deficit. I'm sure you will be able to explain it to Nada and her colleagues in Washington that this is quite a sensible thing to do. So maybe you'd like to comment on that.
Yeah, I think that's an excellent question, Montek. Given the paucity of time, I'll not be able to give you all the details, but I would encourage, and if you have the inclination and others as well, to read the second chapter in volume 1 of this year's economic survey. It was precisely on this question. And let me make 3 observations there. First, and this is based on scholarly research. My contention is that even this 60% debt to GDP was primarily came from the Maastricht Treaty, the 3% fiscal deficit, 60-odd%. And if you look at the academic work, and if you look at, for instance, go and refer to Reinhardt and Rogoff, ignore some of the data errors which don't change the conclusions in any case. Even at 90%, there is some impact, some decline in growth, but growth does happen as well. So I think what we've taken as a holy grail often I don't think actually sort of is backed as much by very careful academic evidence for the advanced economies. Now let me talk for emerging economies like ours. The usual arguments are that are made are, oh, you will have basically crowding out, because you will have crowding out, therefore you actually need to be far more careful. Therefore your debt capacity is lower. But at the same time, I think there's another way of looking at it. Infrastructure deficits and overall, sort of the supply side of the economy. When you contrast with the advanced economies, we have far more opportunity to create that infrastructure, create those assets. And there is good evidence both for the advanced economies and for India that fiscal multipliers are actually much greater for capital expenditure than for revenue expenditure. For instance, in the Indian context, that fiscal multiplier for revenue expenditure is between 0.92 to 0.98, which means there are deadweight costs of between 2 paisa to 8 paisa. In contrast, capital expenditure, the fiscal multipliers are in excess of 2 in that same year, and over the life of that asset in excess of 4. And there are other measures that actually estimate more than this. I'm taking the most conservative estimate here and presenting it. So when you look, therefore, in a dynamic situation, over, let's say, a 2-3 year period, or maybe 4-year period, take into account the fact that fiscal multipliers are greater during times of recession or slowdowns in the economy compared to expansions. When you take that into account, a lot of investment in capex can be self-financing, in a 3-4 year period, and that is important for us to take into account. At the same time, and this is the third point I want to mention, which is, unlike advanced economies which have automatic stabilizers in their economy, we don't have as many. The Manrega is one, but we don't have as many, and therefore the importance of counter-cyclical fiscal policy becomes really critical, because and we all know that as it is, an economy has cycles. When fiscal policy is pro-cyclical, in other words, when tax revenues are greater, you spend more, you basically make it pro-cyclical and therefore exacerbate the cycles and the amplitudes of the peaks and the troughs. In contrast, when you do counter-cyclical fiscal policy, you moderate those peaks and the troughs and thereby reduce aggregate macroeconomic uncertainty in the economy, which is really critical for investment. As all of us would agree that investment, given its long horizons and gestation periods, lower macroeconomic uncertainty, and a signal from the fisc for fiscal policy to be counter-cyclical is really important for investment, private investment to pick up. And these are the directions in which the government has been pursuing. If you look at this year's budget itself, the measures are actually a manifestation of these ideas, and we will continue to do so going forward. Last point I want to mention, and I think I was briefly mentioning this in my opening remarks as well. There is a lot of academic evidence now, especially for countries like India and specifically for India as well, that this argument of crowding out that we traditionally make, that's not necessarily true. The evidence does not, both in a static sense or in a dynamic sense, if you look at, especially because, now there's a lot of, again, good academic research which shows that for, emerging economies where demographies are favorable, savings is pro-cyclical to growth and response to growth. The entire argument of of crowding out is based on a finite or actually a fixed pool of funds from which the fisc is withdrawing. If it withdraws 1 more rupee, there's less left for the private sector. But if savings are pro-cyclical, that pool grows, and therefore in a dynamic sense you actually have crowding in as well. And these are very important arguments, therefore, to take into account. And I believe in thinking about what is right for India from first principles, rather than just copy pasting what advanced economies do. And these are just illustrations of that thinking. Pro-cyclical, that pool grows, and therefore in a dynamic sense you actually have crowding in as well. And these are very important.
Montek, you're on mute.
Take into account, and I believe in thinking
Montek, you're on mute.
What is right for India from first principles, rather than just copy pasting what advanced economies do. And these are just illustrations of that thinking.
Yeah, can I be heard?
Yes.
Yes.
Okay, I'm sorry. Thank you, KB. No, I completely agree with what you said, and I think even in the IMF, for the last several years, a distinction has been made that a fiscal deficit is not just a fiscal deficit. There's a difference between a fiscal deficit which goes up because you are doing giveaways and freebies, and a fiscal deficit that goes up because you're putting investment into infrastructure, and even more so, a fiscal deficit that is addressed as infrastructure that addresses energy transition or rural infrastructure, etc., etc. I think that point is extremely well taken. But, I have a question addressed to Nada. So this has come through me on the WhatsApp group. And what they're saying is that, look, the IMF keeps saying emerging markets are vulnerable, but then all the emerging markets are saying, no, we're not vulnerable. We feel quite confident. So the question arises, could the IMF be being over pessimistic? And just to make you, give you a little personal thing, I remember Stanley Fischer when he was your first deputy managing director, and you were being much criticized in 1997 for somehow not having predicted the East Asian crisis. I mean, Stan sort of said to me, all this putting pressure on the IMF for not predicting a particular crisis. If you create an incentive system where we are criticized for not predicting any crisis, we will be predicting 10 of the next 2 crises. So could you be in that position now, that you are predicting a crisis or worrying about a crisis that really isn't going to happen? So isn't it worth considering whether you need to modify your warning a bit? I know it's a tough question, but you can handle tough questions, and nothing that the audience likes better than throwing tough questions at panelists. So here's yours.
Thank you, Montek, and thank you for that question. I think, I don't think it's a matter of disagreement. I think the glass is always half empty and half full, and it's what part of the glass you are looking at. We at the IMF, we are paid, our mandate is to ensure, global financial stability and global macro stability. And in order to be able to do that, you have to constantly think where could the problem arise from? What kind of problem could it be? And do we have the right equipment to deal with that problem? So that's why, we look at, where the vulnerabilities lie in countries and how these vulnerabilities are moving, because the way, they are moving, suggests how vulnerable they will be to a shock, and if the risk materializes, how it may impact those countries. So, you know, it's important to keep an eye on the vulnerabilities and see how they are moving. I think, you know, the glass is half full because, you know, as I said, the emerging markets entered this crisis with a much more solid footing compared to the global financial crisis. And we recognize that at this point in the pandemic, emerging markets on average still have a lot of buffers on the external side. But we also need to recognize, and this is the half-empty part, that, you know, the recovery is still fragile. And moreover, it's diverging. Advanced economies are, you know, a step ahead. And, you know, partly, in great part, because as Stephany said, they were able to pour more support into their economies because they had, you know, a bigger war chest. So we are in a situation where, you know, the policy synchronization across emerging markets and advanced economies may not be there, you know, for the near term. I'm hearing. Sorry. So we are in a situation where we need to be watchful. And who knows when, if a crisis will happen and when it will happen. I think, you know, what we need to do is to be aware of what the vulnerabilities are and what are the size of the buffers. And I think we do recognize that emerging markets have buffers. And what can be done, you know, in case something happens, to strengthen those buffers and put more, you know, more support on the table, either through bilateral swaps, for example, or through multilateral assistance. So I will stop there. Thank you.
Thank you, Nada. That was NK Singh phoning in. There was some confusion there. So I don't think we are going to have the benefit of questions from him. Deepak, are there other questions that have come in from other people which you want to raise at this point?
Yeah, there is a question for Mr. Subramanian. This is saying that it is generally believed that supply-side reforms take time to show results, which is why many advanced economies pursue demand-side interventions. So why has supply-side reforms been so successful in getting results so quickly in the Indian context? This is saying that it is generally.
I think that's a very good question. Firstly, because this crisis, you know, especially because of its interlinkages between, you know, the saving lives and livelihoods, this crisis, you know, and lockdowns, you know, and your other economic restrictions primarily have impact on supply side. You know, they of course have an impact on demand side as well, because, you know, restrictions have sort of, you know, affect livelihoods, earnings, etc. But when you have, let's say, a night curfew, when as a result of that, you know, trucks that carry vegetables or, you know, perishables cannot move, as a result, there's more wastage. So in economies like ours, where we don't have that good storage infrastructure, what that means is, you know, the supply eventually gets impacted, and so, you know, you get food inflation. You would have, you know, gotten very much higher food inflation, but for these supply side measures. And in a country like ours, you know, retail inflation, for instance, you know, significant contributor of that is food inflation. Now, because the supply side factors were so proximate, so immediate, therefore the response had to be ones that actually focused on supply side measures itself. So I think it is therefore, again, I would mention, it is really important sort of, you know, supply and demand, I think, never go out of fashion in thinking about, you know, these crises. Let me just remark on the demand side as well. You know, India has done enough demand side measures. We've done, you know, primarily three kinds, which is one is in-kind support. 800 million people being given free food over the last, you know, 18 months. It is by far the largest that's been given. You do have to keep in mind that unlike advanced economies which don't have a public distribution system, and therefore they have to actually send checks in order to support, you know, even essentials, right, of the less privileged. You know, and that's something that India has done. Second, India's, you know, measures have actually been far more focused. I'll give you this, very sort of anecdotal example. My daughter is studying, economics at the University of Chicago. Her friends who are U.S. citizens. Now remember, University of Chicago is a private university where parents and these are not underprivileged kids that are coming to study there. They've got $5,000, $6,000 checks, which tells you actually about the spending not being well directed. India, in contrast, has actually done its fiscal spending in a well-directed manner. The cash transfers that have been given have been only to the Jan Dhan accounts. These are basically 400 million accounts at the bottom of the pyramid to widows and women. And finally, a lot of our fiscal support has also been done through the financial sector. And as a financial economist by training, I can tell you that in general, financial sector suffers from adverse selection. But when you actually overlay the financial sector with a credit guarantee, and I've actually written an article in the Times of India where these arguments are laid out, people can refer to it. You actually can convert that adverse selection into favorable selection by overlaying a guarantee and thereby ensuring that the fiscal support is well directed. And let me specifically say that when a section of the population that is suffering both from liquidity and credit problems takes a loan, for instance, the loan support we've given MFI, to microfinance institutions, which is a credit guarantee. If that person, and that person is likely to default because he or she is suffering from both, liquidity and credit problems. So when the loan comes up for repayment, will not be able to repay. With the credit guarantee, the financial sector, MFI can give the loan. Otherwise, it wouldn't have given the loan. People who basically are not suffering from liquidity will not take this loan, but this section will. And when they default and the government fills in through the credit guarantee, that becomes a quasi-cash transfer. And importantly, because defaulting is something that it affects your credit score, only those that cannot repay will default. There won't be any strategic default because that is something that the incentive to strategically default, or basically to take a loan when you don't need it is reduced. That's favorable selection for you. So we've basically done fiscal support through the financial sector because direct government oftentimes cannot target it very well. When you utilize the information that financial sector has and overlay it with a credit guarantee, you're able to provide fiscal support with much less fiscal resources. And I think that is something that India has done. So optimal utilize of scarce fiscal resources on the demand side, together with actually identification of the fact that this is a big supply side shock as well, and therefore supply side measures are extremely overlaid with a credit guarantee.
Thank you. That's very helpful. I think we have another 4 or 5 minutes. Pramod, did you want to raise anything?
Unmute, Montek. Well, sorry, I wanted to say one thing, Montek. I'm sorry, I spoke to NK, and that's why he couldn't join. I think there was some confusion about that. My question is more, micro, I think, rather than it is at the pure macro level. As we think, and this is again for Mr. Subramanian, if I may go to that point. A large part of our targets that we are setting are based on disinvestment and that process of disinvestment that needs to take place over time. And that has obviously been a difficult issue for us for many, many years. So I would love to hear your thoughts on how we can make that, facilitate that, make that easier, because it is something that is extremely important for India. I think it's a great step. I think it's a very good step that the government is taking to do that. And yet the path to success is fraught with a lot of stumbling blocks. So would love your views on that, if I may, because it is something we wholeheartedly would support. The government needs to get out of as much business as it can. And yet, in India, that's never been easy.
I think, that's a good question. Let me tell you that in many cases, when you extrapolate from the past, that is a good indication of the future. But there are occasions when, extrapolation from the past is necessarily not indicative of what is going to happen in the future. And I think privatization this year is an example of that. Mark my words. Air India privatization is going to happen. and this year will be remembered as a very important year in our privatization agenda. After the privatization that happened during the Atal Bihari Vajpayee years, this year will actually be a very important year. But let me, expand on that and, give a little bit more color. I think, privatization itself is a very important step because it is actually, it is an implementation of the policy change, the enterprise policy focused on private sector. For the first time now, India is recognizing that there are efficiencies, there are, gains that can be realized. When you let the private sector do things that, that it is good at, you enable both incentives and information to most aspects of economic policy to work for the economy rather than against the economy. And that is why the enterprise policy focus on the private sector, which states that except for 3 or 4 strategic sectors where there will be, 3 or 4 PSUs, all the other PSUs will be either, will be privatized or will actually be closed. And I think that is something which is very important. Of course, this will take time. It won't happen immediately. But when the process is taken to its logical conclusion, you'll find that the Indian economy will look very, very different from what was inherited, like a few years back. That's the asset monetization is an equally important piece because, you run a private company, you know very well. You buy assets, you also lease assets. The equivalent of that in our policy is privatization is the opportunity for you to own assets, buy them, and asset monetization is the opportunity for you to lease them. And you can therefore combine them optimally at the macroeconomic level. Last point, and maybe you didn't in your framing of the question, but I would say that privatization or just the enterprise policy on the private sector, which by the way is actually sort of coming full circle because the first industrial policy, if you remember, gave the commanding heights of the economy to the public sector. Now we're going to give the commanding heights of the economy to the private sector as part of the Atmanirbhar Bharat push. But there are many other measures as well, which is your labor reforms. It's a very, very important part. The farm bill, even though there is a stalemate on that, I actually remain optimistic that it will, it will go through because it's really important for really improving farm incomes, especially for the small and marginal farmers. The change in the MSME definitions. One of the key problems on our supply side has been that we have dwarfs. Our MSMEs remain dwarfs, which is they age but they don't grow. There's a nice paper in the Quarterly Journal of Economics which shows that in the United States, a 30-year-old firm creates 7 times as many jobs as a 5-year-old firm. The same thing if you look for India, the 30-year-old firm creates only 40% more jobs than a 5-year-old firm, and that is because of the perverse incentives we provide to our enterprises to remain small despite aging. Basically, perverse incentives to remain dwarfs. And that is where the changes in the MSME definitions are very critical, that they'll enable economies of scale, thereby bring down costs and make them more competitive, not only to compete with foreign firms in India, but also in the global markets. Similarly, opening up of several sectors, and look at what you're seeing on the unicorns, right? More than 100 unicorns, which is because of the policy. There is a clear break from the crony lending and the cronyism that we had till 2014. This is because of the policy that's been followed on enabling competition. Even if you look at the telecom reforms, clearly the message there is we want to enable competition. I think as a result, you will see a lot of these measures coming together in bringing more competitive markets and therefore efficiency gains for the economy going forward.
Thank you. Thanks, KB. Actually, I think we're running out of time, but I wanted to address something to Stephany, and I think she wants to say something, so she can take some time to say that too. The question I wanted to address was the broad subject we're discussing is issues of macro balance, and I mean it's traditionally been viewed as financial sector, savings, investment, and so forth. But the underlying phenomenon of strengthening the global trading system somehow is getting lost sight of. Now, to my mind, the simplest thing that would induce a huge amount of confidence that the world is not kind of disinterested in a multilateral trading system is if the US would allow the dispute settlement mechanism of the WTO to work. So, Stephany, you're sitting right there in New York in Columbia University. And I know that the political, I'm not addressing this to Nada, she's an international civil servant and shouldn't be pronouncing on policies of individual countries, important member countries. But, Stephany, what do you think? Is there any chance? Because this, a simple statement by the US administration that we are clearing the appointments of a whole bunch of people so that the dispute settlement mechanism can start working would hugely energize what is at the moment a completely broke system. I mean, as of today, there is no international legal impediment to doing whatever you want on trade, because they will take you to dispute resolution, you will exercise your right to appeal, and the appellate system doesn't work. So is that going to change? How do you read it?
Thank you very much. I think actually I live in the UK, not in the US.
No, I'm sorry.
No, that's okay. But I have attended several conferences on the subject, and what actually, both in Europe and in the US, what has actually shocked me a little bit in so-called progressive circles in Europe and in the US, there has been an increasing change towards less, as you know very well, less enthusiasm to the international trade system, which they very clearly set up after the war. And I think in very simple terms, it is because then the system suited countries, and now it doesn't suit them because they're being challenged by emerging economies, particularly China, Mexico, and so on. So they are resistant to that. And the influence, for example, of the trade unions in those countries, particularly in times when there is higher unemployment, is very strong. And I was involved in preparing a report, which was mainly European, but also we discussed it in the US. And there was this permanent push about, not really wanting to allow full access to international markets to developing and emerging economies. I mean, it was always presented as concern about the environment, about labor standards, and so on. So I think it is an uphill battle, but it is an essential battle. I mean, they invented this model of multilateral trade, of export-led growth. They sold it to us in emerging and developing economies, and they can't just tear it and say, that was then and now it doesn't suit us. But it is very, I think, difficult. And of course, dispute settlement is a particularly strong element of that. And I think emerging economies are completely right to fight for it, and they are sometimes successful. So, and I think multilateralism is particularly important for emerging economies, and particularly small ones, because a country like India or China can at least fight for its rights. But small countries are really naked in the front if there is not a multilateral system. So whatever the faults of the multilateral system, I think it's in our interest to defend it. And of course, I think in the current US administration, things are better, but they're not as good as one would like. The point I wanted to make was in relation to your question, Montek, and to Dr. to Dr. Subramanian's answer in terms of changing the paradigm on fiscal policy, as he rightly replied to you. And I wanted just to highlight that I've seen in Europe a really strong change. I mean, led particularly by Germany, there was a very, very austere response to the Eurozone debt crisis, with high costs for the crisis countries, particularly Greece, but also others like Spain. And this is completely changed. I mean, Germany, in the face of the COVID crisis, has both pursued extremely Keynesian policies domestically, both in fiscal terms, but also through, for example, KfW using the kind of guarantees that Dr. Subramanian mentioned, very, very aggressively. Their lending into KfW increased almost 100% last year. And also they allowed this European Recovery Fund to happen for 750 billion euros, which is financed by joint borrowing by all the European countries, all the EU countries. And this would have been anathema before. And so they took joint debt. It doesn't count, then I think, to the limits. And they allowed all countries to completely suspend for 2 years all these Maastricht rules. They don't count. Debt limits, fiscal deficit limits, they don't count. And there is a discussion on how the new rules will be. It's not clear. But I think this is very interesting. Of course, President Biden has got a very ambitious fiscal program. It's not gone through Congress yet, but so I think the point that you made, and Dr. Subramanian, is very much right what the developed countries are doing. Of course, they have, they can borrow much more cheaply and so on. But I think there is a very strong case, particularly where the investment is very productive, is very green, and so on, for emerging economies to make the same case. I just wanted to supplement.
Thank you. Thanks very much. I think we've overshot the time that our organizers had allotted. So let me, on behalf of everyone who was listening, let me thank Nada and also Subramanian and Stephany for having enlightened us on so many complex things. Thank you all, and I guess I should just say all the best and see you on another occasion. Thank you.
Thank you very much.
Thank you.
Bye. Bye.
Thank you very much.
That was great.
For having enlightened us on so many good. So, things. Thank you all, and